Today I want to talk about valuation, and I want to talk about how we've lost our way in valuation. Now, I've been teaching valuation now for close to 40 years. I taught my first valuation class in 1986. At that time, it was the first full semester valuation class taught at NYU, at any university. And I'll give away my age by giving you a little bit of color on what I used for my first valuation. It was in 1981. I don't even remember the name of the company I was valuing. But you know how I got the information to value the company? I actually wrote to the company, actually physically wrote a letter saying, could you mail me your annual report? Now, I remember saying this in my class a couple of years ago, and somebody said, why don't you just go online? So, online in 1981, there's nothing there. To give the company credit, 2 weeks later, I got back the annual report from the company. And I sat down to value the company, and here were my tools. I had a ledger sheet in front of me. Most of you are too young to even know what a ledger sheet looks like, but a ledger sheet is just a blank sheet of paper with lines already pre-drawn in it, and a calculator. And I entered the numbers with pencil. You learned very early in those days to do everything in pencil because you screwed up, you'd have to cross out a lot of numbers and change them. So my data was limited, my tools were powerless, and I finished my first valuation. Fast forward to April of 2023. So I was thinking about this session, and I was saying, look, now let me think of a New Zealand-based company. And I'll make a confession, I couldn't think of any. So I asked for suggestions, and I got back a list of 5. 4 was so boring that I fell asleep even looking at their names. A port company, a power company. I mean, really, what's the fun in valuing those companies? Then I saw Fisher and Paykel. And again, I'll make a confession. My first reaction is that's the appliance company, right? Because that's the only experience I'd had with Fisher and Paykel, the only products I'd seen. So I decided I wanted to take a look at the company. And to show you how things are different, it took me 5 minutes to download every income statement and balance sheet that Fisher and Paykel had ever filed in their history. 5 minutes. I went an S&P Capital IQ. I could download it in New Zealand dollars, US dollars, whatever currency I want. I could download not just data on Fisher and Paykel, but on pretty much every healthcare product company in the world, and I did. And I had powerful tools. I had an Excel spreadsheet. I haven't quite got to the stage where I put Python in it, but pretty much everything is automated. What I'm trying to say is we have a lot more data than we did 40 years ago. We have far more powerful tools than we had 40 years ago. But in my view, the quality of valuations now is worse than it was 40 years ago. And that's a contradiction I've wrestled with. Why, if we have better data, and more powerful tools, are valuations not better? And today I want to talk about what I think the key reason is. But to lead into that, I want to talk about what I think are the 3 biggest enemies of good valuation. And people ask me, why do valuations go off the tracks? It's not because you can't estimate cash flows or discount rates or the mechanics of valuation. The 3 biggest enemies of valuation, and I call this my Bermuda Triangle of valuation, are bias, complexity, and uncertainty. Let me explain. Most of the time when you sit down to value a company, you bring in your priors and preconceptions into your valuation. In other words, if you really, really like a company, or you like the CEO of a company, you cannot but bring those preconceptions to a company. I ask people who are on the verge of valuing Tesla, before you value Tesla, tell me what you think about Elon Musk. You know what? That answer is going to tell me pretty much everything I need to know about your Tesla valuation. It's almost impossible to separate the two. Bias. Second is uncertainty. Uncertainty is a fact of life, but for some reason it makes us as human beings uncomfortable. We push it away, we hide behind all kinds of metrics and models. But the truth is you have to face up to uncertainty, and we don't deal with it very well. And the third is complexity. As data has become more accessible and available, we've started to build bigger and bigger models. Some of you might have seen valuation models from investment banks run to 200 line items. Sometimes I wonder who's running who. Is the model running you, or are you running the model? The reason I call this the Bermuda Triangle evaluation is bias, uncertainty, and complexity drive us to do really stupid things. And I see some really stupid things masquerading as valuations out there because people have lost track. So let me set the process up with what I think are the drivers of value. When I think about the value of a company, let's think about non-financial service companies. I have a similar set of drivers of financial service companies, but that's for a different day. Focus on a typical non-financial service company. You give me any non-financial service company in the world, I can crystallize that company's operations into three key inputs. Revenue growth, which will capture the growth part of your business. Operating margins, which will capture the profitability of your business. And a measure of how efficiently you deliver that growth. Basically, by looking at how many dollars of revenues you get per dollar of capital invested. Revenue growth, margins, and reinvestment give me your cash flows. You can put this in 3 line items of 50, but ultimately that's where you're going. Those cash flows get discounted back at a risk-adjusted discount rate. I'm not going to hit you around the head with the CAPM, the arbitrage pricing model, the multi-factor model. Frankly, I don't care. You have your proxy for risk, you convert to a discount rate. Common sense says riskier cash flows need to earn a higher return than safer cash flows. Your discount rate captures the risk in your operations. You discount cash flows, which are expected cash flows, at a risk-adjusted discount rate. What you get as a present value is the value of your business. Of course, one dirty little secret about discounted cash flow models that nobody wants to talk about is when you discount expected cash flows at a risk-adjusted discount rate, you're valuing your company as a going concern. What does that mean? You have a bad year, you always bounce back. Why? Because you have to get to nirvana. You know what nirvana looks like in a discounted cash flow model? It's that big terminal value. Without it, your value kind of is meandering in the wilderness. The problem, though, is lots of companies don't make it to nirvana. I value a lot of young companies. You know what percentage of startups make it to year 2? 1/3 of all startups make it to year 3. In other words, 2/3 of startups don't make it through the first 2 years. You do a discounted cash flow valuation of a startup, you got to bring in that failure rate. So in my valuations, a failure rate operates as a mechanism to keep me honest, saying you're valuing a young company or a distressed company, you got to factor in the chance of failure into your valuation. You present a company to me and you're going to see my valuations of at least 2 companies today using this framework. I'm going to try to capture the company in the 6 inputs you see on this page. Now, as you estimate these inputs, I'm going to argue that one thing we've lost sight of is every time you value a company, you're telling a story about a company. To introduce that concept, I want you to look inward and answer a very simple question. There's no right answer to this. It's about you. If I asked you to describe yourself as a person, would you more naturally describe yourself as a numbers person or a story person? Think about it for just a moment. What comes more naturally to you? Working with numbers or telling stories? You think, how would I know? You've known for a very long time. I'll tell you when I knew. I knew when I was 12 years old. It was right after my first English literature class. I was asked to read Moby Dick, and I did. I was a good kid. I came prepared for a discussion of whales and captains. And 15 minutes into the discussion, I noticed nobody was talking about the whale. So I put up my hand and asked the question, when are we going to talk about the whale? And I remember the instructor saying, there is no whale. I said, did I read the wrong book? I distinctly remember a big fish going all the way through the book. She said, it's a metaphor. My jaw dropped. Because the rest of the class was about hidden meanings in the book that didn't even know had a meaning in the first place. I remember coming out of that class with a singular conclusion. I said, never again am I going to subject myself to that kind of bullshit. And the rest of my high school life was laid out for me. I avoided the literature classes like the plague. It was Algebra 1, Algebra 2, Algebra 3 out of high school. I was a numbers person. I prospered in a numbers area. And if I hadn't found my bearings, I'd have ended up in a numbers job like what an engineer, a mathematician, an accountant, an actuary. It's numbers people. Story people, on the other hand, love hidden meanings. So what I'm asking you is what comes more naturally to you? I asked this in my valuation class. I teach a class of 400 MBAs in an amphitheater. When I asked this question in my class, it's a little bit of a selection bias. 240 of the 400 put up their hands and they say, we're numbers people, recovering accountants, recovering bankers, recovering engineers. The other 160 are story people, history majors, literature majors. And I tell them what I hope the class will accomplish for them. I turn to my storytellers and I say, look, by the end of this class, I hope you get enough comfort with the numbers that you become disciplined storytellers. Then I turn to my numbers people and say, by the end of this class, I hope you get comfortable enough with your imagination that you let it loose once in a while. To me, the combination you need for somebody who's good at valuation, you're either a disciplined storyteller or an imaginative number cruncher. As I said, I've been teaching this class for close to 40 years. You know which group I have more trouble with every single time I teach this class? Getting storytellers to develop discipline or number crunchers let loose their imagination. It isn't even close. Every single semester I've taught this class, I have more trouble with number crunchers. You give me 100 history majors, I can teach them all the valuation they need to know to value a company in probably 24 hours. You give me 100 engineers, I'm completely and totally screwed. Because they've spent a lifetime bludgeoning their imagination into the ground. They can't let go. So what I'd like to talk about is the idea that good valuations are bridges between stories and numbers. You say, what does it even mean? When I show you the valuation of a company and you point to a number and say, why is that number what it is? My response has to be a story that explains that number. Conversely, if you tell me a story about a company, it's got a great brand name and amazing management, it's my job to find a number that goes with that story. Good valuations are bridges between stories and numbers. And that's the skill we've lost over the last 40 years as valuation has become financial modeling and you become an Excel ninja. So I want to spend some time today talking about the process of valuation. I know when I picked the two companies, I did not expect to create a controversy with Fisher and Paykel because after I sent the valuation, I was told that I might actually move markets. I'm incapable of moving markets. I don't have that much of an ego. But frankly, I want you to disagree with me on my story and tell me what I'm missing in my valuation. Because that's really at the essence of valuation, is disagreements about stories and how they play out in numbers. You're saying, how come this was never a factor 30 or 40 years ago? And one way to understand why the necessity of telling stories has moved to the forefront is to think in terms of a corporate life cycle. It's one of my favorite structures. I use it in all my classes where I talk about a startup being like a baby, a very young company being like a toddler, falls, gets up, falls, sometimes doesn't get up. Very, very young companies being like teenagers. What do? What teenagers across the world, across time have always done, which is look in the mirror every morning and say, look, I've lots of potential. What can I do today to screw it all up? When I bought Tesla in 2019, for the first time, and I valued Tesla, I found it to be undervalued. I bought the stock, I wrote about it in my blog, and I called it my corporate teenager. I said, every morning I know I'm going to wake up with one man looking in the mirror and say, what can I do today to screw up all this potential? And then you make it through the teenagers in the peak of your life. Enjoy it while it lasts, because it doesn't last that long. Remember, 6 or 7 years ago, Facebook and Google were at the peak of their lives. They're looking awfully middle-aged now, right? That happened in 6 years, because that's what's coming after the peak of your lives. But enjoy middle age as well, because worse things are coming down the pike. You get old, and then you're going to decline, and then you die. I know it sounds morbid, but companies go through this life cycle. They're saying, so what? The type of uncertainty you face will vary depending on where you catch a company. Very young companies, you face an immense amount of uncertainty, and much of it is about the company. As companies mature, uncertainty both decreases and becomes more macro. In other words, if you're valuing Coca-Cola, there's very little uncertainty about the company. There's lots of uncertainty about the macro forces driving it. And you're going to decline, your concerns turn back to the company. The degree and amount of uncertainty and the type of uncertainty you face varies across the life cycle. And here's where stories come into play. Every company's valuation is a mix of stories and numbers. But with very young companies, it's all story. Why? Because what numbers are you going to use? I come to you with a startup and you ask me for my last 10 years of financials, I'm going to laugh at you. I've been around only 3 months or 6 months. There are no numbers. It's all story. As you age, the numbers start to either back your story or tell you that your story is wrong. So as mature companies, you can basically look at the numbers and the numbers will tell the story. It is true you can value Coca-Cola with an Excel spreadsheet. Why? Because the numbers pretty much tell the story. You can value Kraft Heinz. I'm going to argue that you can value Fisher and Paykel with the numbers because it is a mature company. As companies mature, you can get away letting go of the narrative. But I think you should still think about that mix of narrative and numbers. So with that lead in, let me lay out the 5-step process I go through to value a company. It's exactly the process I went through with Fisher and Paykel as well. But I'm going to take you through these 5 steps. And it's a process I follow pretty religiously for a simple reason. My natural inclination when I want to value a company is sit down, open a spreadsheet, and start entering numbers. I have to fight that instinct. The first step when you give me a company to value is for me to develop a story for the company. So let me repeat that again. My first step is not compute 100 different ratios and do 10 years of financial analysis. It's to develop a story for the company. To develop that story, could looking at the past help me? Absolutely. But more so for some companies than others. The second step in the process is stop and make sure the story I've told you is not a fairy tale. In fact, I pass my story through what I call the 3P test. Is it possible? Is it plausible? Is it probable? It sounds like I'm playing on words, but I'll give you examples of exactly what I mean with those 3 words. So you tell a story about a company, you ask, is it possible? Is it plausible? Is it probable? You pass that second test, you've got to convert your story into numbers. And the advantage of having a parsimonious valuation model, remember in my valuation model, everything flows through 3 inputs, revenue growth, margins, and that reinvestment assumption. Every part of your story becomes one of those numbers. Step 4, your valuation kind of does itself. Because once you've told a story and converted into valuation inputs, the rest of valuation is pretty mechanical. So the time you're done with step 4, you have a value for your company. And you're feeling pretty good about that, right? Because it's your story, your numbers, your valuation. And when you show to other people, what do you want them to do? You want them to pat you on the back and say, amazing valuation. This is exactly how I'd value the company too. And I have some advice for you. Don't hang out with people who pat you on the back and tell you what an amazing job you're doing. Hang out with people who think least like you, are most likely to disagree with you. And listen. Call this keeping the feedback loop open. Listen to what they don't like about your valuation. See if you can make your story and valuation better. So let's start the game. Let's start the process by thinking about telling a story about a company. Face it. Tell a story about a company, you need to understand what the company does, right? As I told you, when I first sat down to value Fisher and Paykel, I thought they made appliances. Then as I realized they'd spun that business off, and this is now a healthcare business, and a very specific type of healthcare business, where almost all their products have to do with making breathing easier for people who have trouble breathing, right? From masks to other breathing apparatus. You need to understand the competition. Who else are they fighting for the market share? You need to understand the structure of the business. How does healthcare pay for different products? How do hospitals pay for it? How do patients pay for it? You need to understand the macro environment. In other words, I call this surveying the landscape, understanding your company, understanding what it does, understanding why people like its products and why people might not like its products to get perspective. So I'm going to keep this from being abstract. I'm going to use a couple of examples to illustrate this. The first is a very old valuation. Valuation I did in June of 2014 of a company called Uber. I'm sure you've heard of Uber now, but in June of 2014, it was a tiny company still struggling to make its head above, or to bring its head above water. So June of 2014, I think it was June 3rd, I opened the Wall Street Journal and I see a news story. And here's what the news story says. A company called Uber had raised $3 billion from venture capitalists who had priced the company, that word is being used deliberately, at $17 billion. And I was puzzled. I'd never heard of the company. How did this company get a pricing of 17 billion? We take that back. I said I'd never heard of the company. I'd actually seen the word Uber on my credit card statements in the 3 months leading into June of 2014, because it turned out that one of my sons was using Uber and using my credit card to back it up. Don't ask me how that happened. But I thought he was taking German language lessons, to be quite honest. No umlaut on the U should have given it away. So I said, maybe I should call him. I did, but he was sleeping. 11:30 in the morning, he kept college student hours. So finally, I got hold of my niece, who lived and worked in Chicago. She was technically awake in an awful mood. And I said, have you heard of this company called Uber? And she said, it's a ride-sharing company. I said, what the heck is a ride-sharing company? She said, I don't have the time to tell you. Why don't you download the app and find out for yourself? And that's how I started my research of Uber. I downloaded the app and I hit the app. Magical things started to happen on my GPS. I see a car trying to drive towards me. Why trying? Because at that time I lived in New York City. And in New York City, you don't get from point A to point B. You try to get from point A to point B. Lots of zigzag streets, shut-off streets. I can see the car trying to get to me. And I can see the name of the driver, George. Never had that happen to me with the yellow cab. 15 minutes later, George and the car pull up in front of 44 West 4th Street, which is where I had my office. I run out to the car and say, hi, George. He said, you didn't enter a destination. Where do you want to go? I said, nowhere in particular. Could you drive me around for about 30 minutes? I have some questions to ask you. For a moment, he thought I was a serial killer. But then he said, I can take him, get in the back. And I started asking him questions. I said, is this an Uber car you're driving? He said, no, this is my car. I said, are you an Uber employee? He said, no, I'm just an independent contractor. So why do you do this? He said, I have a job in which I don't make enough money. I already own this car. Uber allows me to earn a second income to supplement my first one. I said, why do you need Uber? He said, in New York City, it's illegal to stop on the street and offer someone a ride. Uber connects me with customers. At that point, I could see why this guy used Uber. It allowed him to connect with customers and make a second income on a car that he already owned. So 25 minutes later, he drops me back off in front of my office. I offered to pay him, and he says, you don't have to pay me. I said, it's free? He said, it's not free. I said, did you enter your credit card when you downloaded the app? I said, yes. So they would charge you. I said, how do you get paid? He said, they'll send me 80% of the fare. And at that point, I could see why Uber did what they did for connecting cars to customers. They kept 20% of the fare. That's a sweet business to be in. Which left me with one final question. Why do people like my son and my niece like Uber? So I managed to catch my son in a waking moment and asked him, why do you like Uber? He said, I can call the car from the bar. I said, that's an advantage. So you must wait forever, right? He said, they come sooner than a cab. I said, really? You must pay through your nose, right? He said, they're cheaper than a cab. I said, the cars must be filthy, right? He said, they're cleaner than a cab. I said, let me get this straight. They come sooner than a cab. They're cheaper than a cab. They're cleaner than a cab. That's when I knew cab service was destined for doom. I got my understanding of the ride-sharing business by people using the ride-sharing business, by talking to drivers, to customers. You think, why don't you look at the financials? What financials? June of 2014, Uber was a privately owned business, which was incredibly opaque about the amount of information it revealed to the public. Much of what I learned about Uber, I learned from talking to people. We underestimate how much you can learn by talking to people. That's going to become the basis for my Uber story, is what I learned about Uber, how it, no. In fact, the one final question I had was, what's so special about Uber? Why couldn't I go down to my basement, buy a really powerful computer and connect cars to customers? You could think of two advantages that Uber had over me. One was $3 billion. They had it, I didn't, a little bit of a disadvantage. The second was the fact that this is a business with networking benefits. You know what that means? As companies get bigger, it gets easier to get bigger. If you're a driver, you want to go with the biggest ride-sharing company. If you're a customer downloading an app, you want to download the app of the biggest ride-sharing company. I kind of understood the business. And if you think about the Uber business model, it's a business model that's been adopted by Airbnb. There's a whole Uberization that happened over the last decade of lots of businesses where an intermediary entered and connected customers to the owners of cars, houses, apartments, etc. So that's the Uber background. I'll use it to tell my story. But then I turned my attention to Fisher and Paykel. As I said, I know nothing about the company. I have no biases, no preconceptions. So I said, first, let me take a look at their history. So this is Fisher and Paykel's history going back to 2000. I've graphed out revenue and operating income each year for the last 24 years. You know what jumps out at me in this graph? How remarkably consistent the company has been. And take a look at the revenue growth. No matter which time period I look at it, it's about 10%. This is a company that's not a 50% growth company, but manages to grow revenues 10% year after year after year. With one exception. You can see 2020, 2021, and 2022, something was happening, right? And you don't need to do too much research to know why. You sell products that help people breathe in the midst of the biggest pandemic in history. Your products become the most sought after products on the face of the earth. So basically what you see is that jump in 2020 and 2021. So this was my starting point. As I looked at the company, I found out what it made. I talked to people in hospitals in the US who use Fisher and Paykel products. It's well regarded. It's not a superstar company in terms of growth, but it's an incredibly consistent company. In terms of margins, its margins have ranged between 25 and 30% for almost the entire time period. Again, remarkably stable. You did get a jump again in 2020, 21, and 22 because of COVID. We'll have to talk about how that's going to play out in the story. Now, to put it in a broader context, the healthcare business overall is a pretty profitable business. So this is all healthcare product businesses globally. And if you look at the last 10 years, I estimate the revenue growth rate and the operating margin each year. This is a pretty mature business with solid operating margins. You know why healthcare products tend to have profitability that's pretty stable? Because the demand is sticky. A doctor gets used to using a particular healthcare product. They don't like to switch. There's a big switching cost. So once you become the established product in the business, it becomes difficult to get displaced. You can't just undercut prices and come in most cases, because doctors will stay with the tried and the true. I don't have much time, so let me cut to the story. In the case of Uber, the story I told was of an urban car service company, which will expand the business by bringing in new users, which will continue to have networking benefits, but they'll be local. In my story, Uber can take New York, Lyft can take Chicago, Didi can take Beijing, so you can have 10 different ride-sharing companies in different parts of the world. My original Uber story, I did assume that they would continue not to own the cars and not to hire the drivers. It's a low capital intensity business. So it's an urban car service business with low capital intensity. My Fisher and Paykel story is they'll continue to be consistent in terms of delivering growth. I don't see a breakout in growth rates where revenue growth goes to 25 or 30% a year. And I think even though you saw a drop off from 2021, you're basically going to see them revert back to that consistent growth. The big question, and this is where I think I might disagree with some people who view the company as a buy, is what I think will happen to margins. It's true in the last 5 years, margins at Fisher and Paykel have been higher than they've been historically, closer to 28, 29% rather than the 25%. But I also know that the most profitable geography for almost every healthcare product company in the world is the US. Why? Because it's a market where they have the most pricing power. Most other markets are negotiating with governments. Their pricing power is restricted. In the US, that pricing power has been relatively unconstrained. But there's a macro story driving in here. I think over this decade, you're going to see far more pushback on pricing in the US, and that's going to reduce the margins, not just for Fisher and Paykel, but across the board for healthcare product companies. That's my story. And that story is going to play out. So here's the bottom line. With those stories, I'm going to cut to the valuation. I'm going to get numbers that reflect the story. So here are my numbers for Fisher and Paykel, a 10% growth, which I think they can sustain. They've been consistent about doing it. I do think their margins will stay around 25% for the near term. But over the decade, I think they are going to come under pressure, not for any fault of their own or because of competition, but because the overall, at least in the US, the pricing pressure power they're going to have is going to decrease. And that remains their most profitable geography. So a slight decrease in margins. They will have to reinvest in R&D to keep going. But for the near term, I give them a break. I let them live off past R&D. My valuation of F&P is driven by my story for F&P being a consistent growth company with margin pressures building up over time. I don't see huge jumps in operating margins. And this is the problem when you take a company which has margins which are already impressive. This is not a 5% margin company. It's a 25% margin company. That's already putting you at the top 10% of all companies in terms of margins. It's difficult to push up your margins when your margins are already that high, especially in the face of macro pressures. You can see my Uber valuation when you get a chance, where I take the urban car service business, convert to revenues and market share. But ultimately, my point is when I'm done and I show you my valuations for the companies, every number in my valuation will have a story attached to it. And every story I tell you about the company is going to have a number attached to it. In my 2014 valuation of Uber, my story is an urban car service company. The value that I got for the company was $6 billion. The reason I keep emphasizing the data is I valued Uber every year since 2014, including at the time of their IPO. My valuations and stories have changed over time, and I have no qualms about letting that happen, because when you value young companies, stories are going to evolve over time. My Fisher and Paykel valuation is disappointing, to say the least. I mean, I get a stock price about 1/4 of the actual stock price. And I can change margins to 30%. The only way I can get up to $27 is by giving the company 20% revenue growth instead of 10% revenue growth. So I'm going to break out revenue growth, which would require a new product that I've not heard about, perhaps a new management, some big change in the company. But margins alone cannot get me even close to $27. So we talked about feedback loop. In my Uber valuation, I heard from plenty of people who disagreed with me, including Bill Gurley, who is a partner at Benchmark Capital, an early VC investor in Uber. And I listened. And I learned about valuing young companies because I listened. I'm sure there's something I'm missing, something big, because I've seen at least 3 equity research reports that were sent to me. I won't name the investment banks, all of which were putting buy recommendations on Fisher and Paykel. I am truly curious to see how, from an intrinsic value perspective, don't give me EBITDA multiples and pricing multiples. I'm not interested in those. From an intrinsic value perspective, I want to see, because let's face it, you're paying 60 times earnings for a mature healthcare product company right now. That's what you're paying right now. The only way you can justify 60 times earnings is some explosive growth. And I just don't see that happening. Perhaps you have inside information on COVID hitting every 3 years. God help us if that's the case. And maybe that can explain the high prices. But I just don't get it. But as I said, this debates about stories are healthy because it forces us to think about the business, about business models, whereas debates about revenue growth rates and cost of capital are not, because you're talking about numbers that are disconnected from reality. I think I'm out of time, so I'm going to wrap up and open up for any questions you might have, and that's about it.
Aswath, thank you very much. Fascinating presentation. And I loved your line, valuation is a bridge between stories and numbers. And let's expand a little bit on that. First question, we'll take some from Slido shortly because they are coming through. And by the way, do submit your questions through and we'll try and get through as many as we can. We've got about 10 or 12 minutes for questions allowed. But Aswath, if I can kick off with this one, why do you think we have this emphasis on numbers over narrative, that's changed in the valuation process as data has gained precedence? And do we simply blame tools like Excel for giving us the ability to do that? Why do you think this evolution has happened?
Have you been into a doctor recently?
Yes.
Think about what happened, right? You go into a doctor, what do? They run a battery of tests on you, right? I mean, I'm old enough to remember when you went to the doctor, they talk to you, what's hurting, how are you feeling? All those formalities are gone, right? You now run a battery of tests. The tests supposedly tell you what's wrong. You go into a mechanic, he plugs your car into a computer. The computer runs a scan. It gives you a numerical, this is what's wrong with your company. This is not just valuation, right? This is something we see in every aspect of our lives, is we see numbers replacing the capacity to read what's happening. And I think it gives us a false sense of precision, a false sense of security, that if you measure something, you're in control of it. So I think it plays into human nature, which is if I show you a spreadsheet full of numbers, you feel more reassured that I've done my homework than if I tell you a story about a company backed up by a rudimentary valuation. And I think people who are numbers people know that and they use it to intimidate. Why do you think a banker puts up a spreadsheet with 500 numbers on the spreadsheet? You know exactly what's going to happen when you flash 500 numbers in front of people. They stop asking questions. It's just too intimidating. So at several levels, I think that this helps people, in a sense, sell the unsellable, is because it's backed up with numbers.
Thanks for that. Audience question, what are the biggest mistakes investors can make in valuing stocks and shares?
Having too strong a prior view on the company. As I said, bias is the biggest enemy of valuation. I tell, I know New Zealand is a small country, so if you're an equity research analyst, you probably know the CEO of the company, you probably belong to the same social circles he or she does. That's all. That's already a fatal mistake, right? Because once you know a CEO of a company and you really like that person, it's very difficult to put a sell recommendation on a company. You feel too strongly about a company. So I think sometimes keeping your distance from a company is really difficult to do. And especially in small markets, it's almost impossible to do. But to me, that's the biggest challenge in valuation, is to be able to be objective, to not let your priors drive your choice of numbers.
So what would you say about a market like New Zealand, which is a very small, I think one of the smallest actually in the world, perhaps apart from Fiji? I mean, what are some of the traps that are potentially going to exist in this market that obviously you don't have to worry about in a market the size of the US?
Tunnel vision, right? And in fact, I talked to a few New Zealanders about why they like the company. And they said, it's a great company. I said, relative to what? Relative to other New Zealand companies. I said, okay. That's a perspective that's going to govern how you think about the company. But the reality is it's a healthcare products company. It happens to be New Zealand, but if you're thinking about should I invest in it, why isn't your perspective broader, looking at healthcare companies in other parts of the world? So I think it's easy to get tunnel vision when you're in a small market or a small sector. And stepping back sometimes and asking, how does this company fit into the broader landscape? Is, I think, a useful thing to do because it gives you back your perspective.
Good question and a relevant one. How do you value the potential of an idea like ChatGPT?
Well, I think in a sense, the metaverse, ChatGPT, Web3, first thing to remember is these are weapons of mass distraction. Companies will use them because they want to get a higher price. AI right now has become this magical word, right? I mean, today NVIDIA came out with its earnings report. The stock added another $100 billion to its market cap after close of trading today. 100 billion in one day. I don't know what the entire market cap is of the New Zealand market. NVIDIA added that after close of trading today. Why? Because AI. That's it. That's what's driving it. People are convinced that NVIDIA chips are going to be what drive AI. I'll make a prediction about AI in general. When all is said and done, AI is going to make companies less profitable, not more profitable. Collectively, we're going to be less profitable as businesses because of AI. The only people who might gain are the people who sell AI products, but they're a minority. The bulk of the market, this is going to become another cost. And the reason I can say that is I have perspective. I remember when PCs first came out. That's how old I am, 1980s. I was told this was going to make companies so much more efficient and so much more profitable. Guess what? It didn't. AI, in fact, will, I think, deliver this. Now, I have a saying for any of these. If everybody has it, nobody has it. And everybody will have AI, and nobody will have AI. This is not going to be an advantage.
Do you have examples, another audience question, do you have examples of where your valuation is materially different from the market price? And did the market price end up converging with your valuations?
Ultimately, I don't care, right? Because the essence of valuation is you value a company, you make your decisions based on value. Sometimes you're going to be right, sometimes you're going to be wrong. On average, I've turned out to be more right than wrong. But I view this as part of the process. So I'm not going to take a stand on individual companies and say, this is live or die. I value Tesla every year since 2013. I've been more wrong than right. But that's not going to stop me from valuing the company. So the essence of valuation is sometimes you're going to find a value different from the price, and you have to make decisions based on your valuation. But I'm not going to thrust my valuation and my decisions down other people's throats saying, you shouldn't be buying the company, because I think every person has to make their own judgment on story and numbers to make their own decisions.
Just circling back to the ChatGPT, do you think ChatGPT is going to perhaps switch that emphasis back more towards the narrative, or do you think it's going to exacerbate the issue with numbers?
I think it's just going to make numbers worse, right? Because you can turn ChatGPT loose on S&P Capital IQ, God help you. You'll have Excel spreadsheets being created by an artificial intelligence, which will then tell you the numbers story and it'll make things. I mean, I don't see good things coming out in valuation from ChatGPT. It's going to take the mechanical and make it even more hyper mechanical. So from that perspective, if you're hoping that somehow ChatGPT is going to turn this thing around, I'm not that hopeful.
How many hours went into the F&P valuation, just out of interest? Few people are interested in that.
How many hours did I spend? As few as I could, because I was grading. I was grading all month. So that's why I said my knowledge of the company is peripheral. Maybe there's a new product that I haven't heard about. I tried to find whatever I could in the news. So from that perspective, I know far less about this company than most of you do, which is a disadvantage. But it's also potentially an advantage. I have zero priors and preconceptions about the company. I'm just looking at what the numbers tell me about the company and getting a sense of what the company's done over time. And what I see is a really good company, a company that's consistently delivered solid growth and high margins, but not the kind of company that deserves to trade at 60 times earnings.
How do you apply perceived market mispricing in investment strategy? Do you have to consider factors such as the likelihood of certain companies, industries reverting to their intrinsic value?
That's always implicit, right? Because not only do you have to be right, the market has to come around to your point of view. In fact, I tell people, look, we all believe in efficient markets. The only question is when markets become efficient. If you're an active investor, you take a big position, then you get down on your knees and say, please, God, make markets efficient now. Because if markets are never efficient, you can pick all the mistakes in the world, but you're never going to make money. The one thing I would recommend for people, and this is something that I would say that might go against the grain if you're an old-time value investor, is spread your bets. Don't buy 3 undervalued companies, buy 15 undervalued companies. Because you need time as your ally, you need to get lucky. And if you put all your money in 3 companies, even if you truly believe in them, there's a real chance you could end up spending the next few decades waiting for the correction to come. So spread your bets, because I think it makes it easier to act and gives you some kind of buffer against markets not correcting mistakes.
Final question, Aswath, we're just about out of time. I think it's probably a good one for you to go out on because you kind of alluded to this slightly at the start about your viewpoints. But what is your perspective on the ESG factor when valuing a company and the effect on market price?
Do you want to hear it? Do you want to really hear what I think? I mean, people who actually claim to measure ESG have no idea what they're measuring. It's the emptiest concept simply because of that reason. I've actually tracked. ESG started off as a measure of goodness. It came out of a UN document. Then it became a measure for alpha. Remember that middle of the last decade when you're told you could make higher returns by investing in good companies? That was a lie. Then it became a measure of risk in 2020 and 2021. And then Russia invaded Ukraine and they decided risk wasn't working. Now it's a measure of disclosure. That's quite a fall from in the world, right? From goodness to alpha to risk to disclosure. Soon they'll be telling me that they picked ESG because those are the 3 favorite letters in the alphabet. I mean, this is actually a substanceless concept. It's a concept that's been sold without shame. I'll give you exactly the words I used to describe ESG. ESG is a concept born out of a UN document, born in sanctimony, nurtured with hypocrisy, and sold with sophistry. And I can't think of a better way. But if you ever buried ESG, I hope those words go on that tombstone right there.
Thanks, Aswath. I'm sure we could keep going for another hour, and I get the impression you're only just getting started. But unfortunately, we are out of time. Thank you so much for your insightful presentation, and particularly your work on completing that F&P Healthcare valuation. The company will actually report its full year results tomorrow by coincidence, so we're looking forward to following it with interest in light of your comments. So please join me in thanking and acknowledging Aswath Damodaran.